For decades, trade between Canada and the United States was a model of perfect intimacy. From auto parts to aluminum, from forest products to dairy, almost everything flowed across the border every day, and the bond between the two countries was considered unshakable. Now, President Donald Trump's harsh and unpredictable tariffs are causing deep unease in Canada. On one hand, he threatens to impose heavy burdens on sectors such as oil, steel, aluminum, and agriculture. On the other hand, he has already done so several times.
As President Trump stated yesterday, he is still committed to placing tariffs on Canada starting as early as tomorrow, possibly.
Nevertheless, Canada is pushing back, declaring it will not surrender its position as a major crude oil exporter to the United States. As America's largest supplier, Canada exports up to 4 million barrels of oil per day, but is now actively exploring alternative markets. The question of whether Canada might prioritize China or the European Union over the U.S. no longer seems far-fetched, particularly with the completion of pipeline projects like Trans Mountain. Reports of tankers departing from Vancouver bound for markets such as China and Japan have raised concerns in Washington. There is growing speculation that if Trump's trade threats persist, Canada could swiftly pivot to what he refers to as the third option. This shift comes at a critical juncture for Canada's oil exports, which have historically relied heavily on the U.S. market. For years, 90% of Canada's daily oil flow has been directed to U.S. refineries. However, with the expansion of the Trans Mountain pipeline, Canada has gained access to the Pacific coast, enabling crude oil to be shipped via tankers to China and other Asian refineries. Just a few years ago, such a scenario would have been dismissed as impractical, given the U.S. market's dominance and logistical advantages. Today, data from the China Institute reveals that half of all oil exports through Vancouver are destined for China, a development that poses a stark question to the U.S. Are you willing to lose us? Furthermore, Canadian crude oil could become more expensive for American refiners under Trump's tariff policies, making it a more attractive option for Chinese buyers. This dynamic has prompted Ottawa to issue a clear warning. If the U.S. continues to apply unilateral pressure, Canada will forge new oil agreements with China. The strategic crossroads at which Canada finds itself underscores a significant shift in global energy trade dynamics, with potential long-term implications for U.S.-Canada relations.
There are growing fears of a major global trade war tonight after President Trump announced sweeping tariffs on imports from Canada, Mexico and China starting tomorrow.
In the United States, many analysts argue that Trump's tariffs are not without consequences for America itself. While protectionism may appear to safeguard domestic industries on paper, in practice, it disrupts supply chains and results in higher costs for consumers. Additionally, increased prices for Canadian oil or metals could undermine the competitiveness of U.S. refineries in the global market. A massive consumer market like China would be more than willing to purchase Canadian oil, refine it domestically, and then sell it on the world stage. This is the fundamental logic of trade. If one side unnecessarily closes doors or inflates costs, the other side will seek new opportunities. Canada's Trans Mountain pipeline exemplifies this shift, and it may only be the beginning of a broader strategic realignment for Canada. By strengthening ties with China, Canada could pave the way for larger oil deals, echoing what was once referred to as the third option. This approach, which seeks to reduce reliance on American dominance and foster deeper cooperation with other trading partners, is not new. In fact, a similar debate took place in Canada 50 years ago, when the third option policy aimed to break the country's overdependence on the United States. Today, as Canada explores new partnerships, the echoes of that earlier strategy are becoming increasingly apparent. Now, under pressure from Trump, this debate is reigniting. What are we going to do? We are too dependent on the United States. The slightest trade tension gives us a headache, say some voices within Canada. This time, however, China is not the only option on the table. The European Union is also a viable alternative. The Comprehensive Economic and Trade Agreement, CETA, has already reduced tariffs between Canada and the EU to nearly zero. While geographical distance remains a significant challenge, Canada's stance is clear. At least we can find ways to overcome these difficulties and develop methods to send oil to the European Union or Asia so our hands are not tied. This strategy gives Canada leverage in trade negotiations. Consider this. The United States imports about half of its crude oil from Canada, most of which is heavy crude. If Trump attempts to pressure Canada with tariffs, Canada can respond by saying, "There are other buyers for my oil." Among these potential buyers, China stands out as the most prominent. There are even reports suggesting that Canadian oil could create new opportunities for China. If U.S. refineries are forced to purchase Canadian crude at higher prices, they risk losing their competitiveness. Meanwhile, Chinese refineries could secure more advantageous prices and expand their share of the global oil market. For Canada, this shift would mean moving away from the instability of U.S. tariffs and securing a foothold in a massive market like China. This possibility has led many experts in Washington to warn that Trump's policies could backfire. The fact that the two nations have reached such a sharp crossroads is fueling frustration among politicians in Ottawa, who firmly assert that Canada is not a submissive nation. The growing tension underscores a pivotal moment in Canada's trade strategy as it seeks to diversify its markets and reduce its reliance on the United States. Trump's threats are seen not just as an economic challenge, but also as an assault on 4 decades of neighborly relations. This sentiment has sparked public protests, with some even booing the U.S. national anthem at sporting events. In this tense climate, Canada feels compelled to take significant steps, not only with the Trans Mountain Pipeline, but potentially with Energy East or Northern Gateway as well. Despite obstacles like resistance from environmental groups, objections from indigenous communities, and federal-state conflicts, the possibility of constructing new pipelines is gaining traction. The argument is that Trump's actions have forced Canada's hand. While this may not lead to a complete revolution, there is a serious debate in Canada about the need for greater coastal access to Asia, which would involve more tankers. These plans are under consideration, but their realization is far from guaranteed. Global oil markets remain unstable, the economy is slowing, environmental opposition is fierce, and logistical costs are high. Yet for Canada, the cost of remaining overly dependent on the United States could be equally steep. While the deep ties between the two nations cannot be easily severed, Canada's growing efforts to diversify its markets are weakening America's bargaining power. This raises the critical question: what will Trump do next? Although the U.S. president has temporarily paused tariffs, he has made it clear he is ready to reintroduce them at any moment, stating, "I will find new justifications." This uncertainty is pushing Canada to develop a Plan B to avoid being caught off guard. The possibility of a Canada-China oil deal, which could provoke Donald Trump, is not as far-fetched as it might seem. As a result of all this, the question arises: will the greatest economic bond between Canada and the United States ever be shaken? The surge in projects like Trans Mountain and the tankers heading from Vancouver to China suggest a shift. However, the United States still holds a geographical and logistical advantage, likely remaining the most profitable market for much of Canada. Perhaps this is just a strategic maneuver, a stick-and-carrot tactic, where Canada aims to pressure Trump into backing down by highlighting alternatives like the European Union and China. In the U.S., consumers may push the government to avoid raising gasoline or produce prices due to tariffs. Who knows? Maybe both sides will make concessions and find a win-win solution. Such a trade showdown could ripple beyond Canada and the U.S., impacting global oil markets and even refineries in Europe and Asia. Once again, the world is being rattled by the trade disputes of major powers. Perhaps after 30 days, Trump will announce, "I am implementing tariffs," and Canada will respond, "Then I am signing a major oil deal with China." If that day comes, the flames of this trade war could scorch both economies. However, some analysts believe the two nations will reach an agreement before reaching that boiling point. Still, this uncertainty is fueling market anxiety. What do you think? Can Canada export significant amounts of oil to China or the European Union as an alternative to the US? Or will geographical and political realities stand in the way? Will Trump's tariffs truly result in a painless outcome for the US? Or is losing Canada a far greater cost? These questions remain open, and the world is watching with bated breath. Share your views with us, and don't forget to subscribe and turn on notifications. How this high-stakes energy chess game unfolds will shape not only the future of these two nations, but also the global trade. Thanks for watching.